Following the passage of tax cuts, the US administration's focus is on rebalancing US trade with its foreign trading partners, in particular in attempting to reduce the US trade deficit. We've seen this most recently through Section 301 tariffs, which is targeting around $50 billion worth of Chinese exports to the US, and we'll come back to the impact of the Chinese retaliation on $50 billion of US exports to China shortly. But there's another method by which the US can encourage foreign trading partners to change their practices. It's the Treasurys Foreign Exchange Practices of Major Trading Partners report. It's published semi-annually in April and October, and the next report is due soon. In the report, the US has a framework by which it measures its foreign trading partners' surplus to the US, it measures its trading partners' current account balance, and it determines whether the trading partner has performed currency intervention in the previous 12 months. Now, Korea is one of the main trading partners which is being targeted by this report, and in last October's report, the behaviour of the Korean Ministry of Finance changed and the Korean won strengthened. Now, following the agreement between the US and Korea to update their trade deal and the side agreement to encourage more transparent currency behaviour, we expect the Koreans are under pressure again, and we think the Korean won is likely to strengthen in the coming weeks. Now, onto the retaliatory tariffs. China has imposed a 25% tariff on US soybean exports. Now, the reason this is interesting is because the US and Brazil are the main soybean exporters in the world, and China is the main importer. And this tariff is likely to benefit Brazil as it approaches a record production season, and the US is unable to satisfy demand because of increased costs. So in our macro strategy portfolio, we sold dollar Brazil on the expectation that Brazil would be able to capture market share and the real should benefit. But in the longer term, if these tariffs escalate and we enter into a trade war, the US is not likely to weaken anymore. The dollar is likely to strengthen as we move from a trading partner rebalancing to a global risk-off environment, and US investors repatriate their investments home, and the dollar trades like a normal risk-off currency and starts to rally. So in the short term, the dollar is likely to weaken as foreign trading partners rebalance, but in the longer term, if these tariffs escalate, we could be seeing a more volatile risk-off environment.